So we have worked out all the variances. Now our job is to find out operating statements. Okay. So this question has not asked us for operating statement, but still we'll work it out so that you will get a better idea as to how operating statements are useful. Okay. So operating statements. Okay. And this is for absorption costing. Okay, so first what we'll do, we'll tell you like what is an operating statement. See, operating statement is a reconciliation. It tells like what is the company's budgeted profit, like what they expected, and what is the actual profit. Okay, so there is a difference between the budgeted profit and the actual profit. So the difference is usually because of the variances. So what we do is we list out all the variances and we try to find out why that difference has occurred. Okay, the difference between budget profit and actual profit. So we'll start from here. So the first item would be budget profit. The second item is sales volume variance. Okay, the next one. So once we have done this, it's called as standard profit on actual sale. So thereafter we can list all the variances. So again we have sales price variance. So from there on, we just have to list all the variances. So we have material price variance. Then we have material so so the next one is material usage variance. So thereafter we can have the labor variance, labor rate variance, then labor efficiency variance, thereafter we have variable overhead variance. Okay, in variable overhead variance, okay, I think we'll cut short it to variable overhead expenditure variance. Then we have variable overhead efficiency variance. And then we have fixed overhead variances. Okay, in fixed overhead variances we have all these. So in fixed overhead variance we have to show the maximum numbers. So if you see, if you show all of the 5 variances in fixed overhead, there is a problem because expenditure volume is again the cost. Okay, so you should show either expenditure volume or cost. So that is the concept here. So it is better to show a detailed one. So you can show expenditure and volume and cut off the cost. Okay, and thereafter volume is equal to capacity plus efficiency. So you can either show volume or you can show a detail of capacity and efficiency. So you can cut off volume, right? So let's get the fixed overhead expenditure variance. So these overheads would be more than enough. So finally you will end up with, when you do all of this, you will end up with actual profit. So we'll get all these numbers here. So first let's get the questions down so that it's easy for us to work out certain numbers. So we'll start from budget profit. What is a budgeted profit? So budgeted profit is a estimation. Okay, we want that kind of profit. So how much is it? So if you see, budgeted profit is 3.5 per unit. And how many units they thought they will produce? They thought they will produce 2000 units, right? They thought they will produce 2000 units. So you can start from there. And what's the actual profit? So actual profit is 8,805. So you can go to the last number here, 8,805. Okay, so all these variances should explain the difference between these two numbers. Okay, so from here on we can take these, we don't require these tables, so we can paste them at the top, but we need all these variances. Okay, so we have to copy all of them. So we'll start from here. So the first one is volume. So sales volume variance is 1400, which is adverse. Okay, so don't look at the symbol will mislead you. Look at whether it is favorable or adverse. So favorable means we have to put it as plus, and adverse is a minus. Okay, so look at the whether it is volume is favorable or adverse. It is adverse, so it is adverse. So as it is adverse, you can put a minus symbol. It is 1400. So add that, you will get standard profit on actual sales. Okay, what is the standard profit on actual sales? You just have to add both the numbers, right? You got this number. So from this number onwards, okay, from this number onwards, you are going to keep on adding and deducting all numbers. Okay, so from this number is the adjusted number here. So what is the sales price variance? Sales price variance is favorable. Okay, it is favorable, and 6,200. 6,200. Okay, all the cost variance we'll put it in this column, and finally we will put it in the last column. Okay, so we will put it as total cost variances like that. So we'll put just one number outside of the column, because if we put all the numbers it will confuse us. So we'll start from material. Okay, material gives you a variance of 2700, which is favorable. Okay, see, the symbol is not important, the word is only important here. So 2000 is favorable, 2700 is favorable. Okay, so the next one is usage is 4500 adverse. Next one is labor variance. So labor rate variance is how much? It is 630 adverse. Efficiency is 200 favorable. Okay, so labor is done. So we have like two more variances. We have variable overhead and fixed we have. We'll copy that also. So variable overhead expenditure variance is 60 favorable. 60 is favorable and efficiency variance is 100 favorable. Fixed overhead variance, I think we have a lot. So let's see what they are. We want expenditure overhead. So it is minus 325. Next one is capacity, minus 750. Again minus 750 is adverse. Then efficiency is 150 favorable. Okay, 150 is favorable. So that's it. We don't need these variances anymore. We'll just check. Expenditure is 325 adverse. Capacity is 750 adverse. Efficiency is 150 favorable. Okay, so we don't need these numbers. So that's it. We have got all our variances. We just total them. Okay, so the answer comes to minus 2995. So we can put that number here, minus 2995. So the answer should tally. So let's check whether the answer tallies or not. So how does the answer tally? The answer should come to this number 8805. It should come. Let's add it all. So we'll sum up the cost variance total, the sales price variance alone, and this one. Okay, the standard profit on actual sale. This put together should come to 8805, and it has come to 8805. Okay, so see the question is, so the concept is, we have done our operating statement and we have done our variances also. So in a question, this kind of a question can come up for 1 mark. Okay, a small part of it, just one variance like sales material price variance alone can come for 1 mark, or it can come for a little bit complicated and they can ask for 2 marks. This sum can also come for 5 marks. For example, material variance alone they can ask for 5 marks. Okay, or they can ask you to compute all of the uh, variances alone, like how this sum asked. Okay, up to here they ask if it can be like 10 mark or 15 mark. Okay, up to all the variances alone, or it can also be just this operating statement where they give all these numbers. Your job is to just add and deduct it and just find out the answer. That can be like 5 marks. Okay, so variance costing, this is the most lengthiest problem. Okay, we have a little bit complications here and there, but this is itself a comprehensive problem. So ensure that you understand this, because based upon this problem only, like all problems are based. Okay, so ensure that you understand this one. uh, we'll also like summarize this so that you'll get an idea. So if the question asks you to find out all the variances, so start with any variance you want, that doesn't matter. Okay, sales variance is like usually the only the income variance. All other things are like cost variances here. So first work out the income variance. Okay, income variance is usually quite easy. And what we are doing is we are doing still for absorption only. We are not done for marginal. Marginal we'll do it separately in the next sum, and I'll show you how it differs. So you start from sales variance, find out what is the standard quantity of material sold, actual quantity of material which is sold. Okay, standard price will be given in the sum. Actual price, okay, sometimes you have to divide and find it out like this. Standard margin is the selling price minus all the cost. Okay, selling price minus all the cost here, so that comes to 3.5. Okay, so apply it in the formula. In material variance, the tricky part is the SQ. SQ is the most tricky part. How do we find out it? What is the material it takes to produce 1 unit? It is 25 meters of cloth. Okay, that's what we saw here, 25 meters of cloth. Totally how much you are actually producing. Okay, how many units you are actually producing? If you are producing 1800, in that terms it is going to be 25 into 1800. Okay, so that's why we got 45,000 meters. Okay, actual will be usually given. So other numbers are quite easy to find also. Labor variance is also the same kind of problem. We know what is the time taken for single unit. It is 2 hours per unit. You got it from here, 2 hours per unit. And we produce 1800 units, actual units. So multiply, you'll get the answer. Other numbers are quite easy, except for actual rate. He has not given actual rate. It is hidden. So they have worked for 7630 hours divided by 3500 actual hours. You will get this 2.18. Okay, so variable overhead, usually it moves along with labor overhead only. Okay, but in this sum he is very clearly he said that labor 2 hours, variable 2 hours, and fixed overhead 2 hours. Okay, so they are all of them are like equally moving only. So if we, what is the standard hour? Standard hour is it takes 2 hours to produce a single unit. So for 1800 actual unit, it is 3600 hours. Okay, so again actual rate is not given directly, it is hidden, so you have to again find it out. So 3440 divided by, we are assuming the same labor hour will be incurred for variable also, so it is 3440 divided by 3500. You got this number. And the last step is fixed overhead variance. This is the most confusing variance. Okay, so we thought of producing 2000 units. Okay, at a budgeted fixed cost per unit of 3. Okay, don't take these numbers, it is 3. So first get the budget. Actual is directly given in the sum 6325. Look here, it is directly given here 6325. So don't worry about actual. What about the recovery and standard? Recovery is budget overhead, which is 6000 divided by budget units. We thought of selling 2000, but we sold only 1800. Standard is budgeted overhead divided by budget hour into actual hour. Okay, so we thought of producing 2000 units at 2 hours per unit. So 6000 divided by 2000 into 2, which is 6000 by 4000, into actual hours is 3500. Okay, actual hours is 3500. How did we find out actual hours? The assumption is whatever hours, see this 2 are equal, so it means that labor hour would be actually flowing to variable and fixed overhead also. So we got our actual hours from labor hours. Okay, so we found out everything, and then we found out the operating statement. Okay.